The day money dies, how every empire collapses and what survives after. 1. The rule, not the exception. Every empire swears its money is safe. Every government insists its promises will last forever. And every single time, history proves them wrong. From Rome to Lebanon, people have watched savings vanish, salaries crumble, and futures stolen by systems they thought were solid. Currency collapse isn't rare, it's routine. The illusion of permanence is the most dangerous financial belief you can hold. Money is not metal. It's not paper. It's trust. And when trust breaks, the numbers in your account mean nothing. So what does that actually mean? It means wealth isn't destroyed, it's transferred. From those who believe to those who prepare. Footnote. History demonstrates that all fiat currencies eventually collapse through debt saturation, debasement, or hyperinflation. Real assets preserve purchasing power when trust fails. 2. The Byzantine warning. The Byzantine Empire outlived Rome by 1,000 years, powered by one coin, the gold solidus. For centuries, it was the world's reserve currency. Merchants from Asia to Africa trusted it like oxygen. Then came the temptation that every ruler eventually faces, debasement. They began mixing in cheaper metals, shaving purity, stretching supply. At first, no one noticed. Then markets did. The solidus collapsed in credibility, and so did the empire's trade. Those who survived weren't the loyal subjects holding coins, they were the doubters holding gold, land, or goods outside imperial reach. Footnote. The Byzantine solidus, introduced in 312 AD, remained stable for 7 centuries before debasement under the 11th century emperors caused monetary collapse. 3. The Black Death and the power of liquidity. Between 1347 and 1351, the Black Death wiped out half of Europe. It shattered economies but also rewired them. With half the workers gone, labor became precious. Survivors demanded higher wages, bought abandoned land, and rose in class. Those who had cash or goods didn't just survive, they advanced. Those living hand-to-mouth starved or became tenants of the new rich. Sound familiar? During COVID-19, the pattern repeated. Governments printed trillions, asset owners got richer, and wage earners fell behind. Pandemics redistribute wealth, but only in one direction. Footnote. Pandemics historically accelerate inequality. Survivors with liquidity acquire depreciated assets, while debt-burdened households collapse. 4. Florence and the first too big to fail. In the 1340s, Florence was the Wall Street of its day. The Bardi and Peruzzi banks financed kings, until King Edward III of England defaulted. The entire Florentine banking system imploded. Depositors learned a timeless truth: reputation is not collateral. Too big to fail is a fairy tale that predates skyscrapers. When institutions fall, they take your savings with them. Footnote. Edward III's default in 1343 bankrupted Florence's leading banks, proving systemic contagion centuries before modern finance. 5. The Civil War and America's forgotten collapse. During the U.S. Civil War, both sides printed money to fund the fight. The Union's greenbacks and the Confederacy's graybacks shared the same fate: hyperinflation. Confederate bills lost over 99% of their value. Soldiers' paychecks were worthless before they could spend them. Only land, food, and gold held value. America has already lived through a full monetary collapse, we just stopped teaching it. Footnote. Confederate inflation peaked at over 9,000%, reducing entire salaries to fractions of a loaf of bread. 6. France and the Revolution's paper mirage. In the 1790s, revolutionary France issued assignats, paper currency backed by confiscated church lands. It sounded noble. It ended in chaos. The government printed endlessly, bread riots returned, and the people learned that patriotic paper burns just as fast as royal gold. Those who survived held food, silver, or land, anything tangible. Footnote. The assignat collapsed by 1796 after inflation exceeded 13,000%. The lesson: moral conviction can't stabilize a printing press. 7. Asia's debt trap. In 1997, Thailand's baht collapse triggered the Asian financial crisis. Nations chained to foreign currency debt, Indonesia, Korea, Malaysia, fell like dominoes. Currencies halved, unemployment exploded, and the IMF demanded austerity. The pattern was ancient: when your debt is in someone else's money, sovereignty is an illusion. Footnote. The 1997-98 Asian crisis erased $2 trillion in market value and forced multiple governments into IMF bailouts. 8. Lebanon and the modern freeze. Between 2019 and 2021, Lebanese banks locked their doors. Depositors couldn't withdraw, their savings were frozen. The national currency lost 90% of its value. Doctors, teachers, retirees, all wiped out overnight. It wasn't a collapse of money. It was a collapse of trust. Those who survived had diversified abroad or held real assets outside the banking system. Everyone else became hostages to financial triage. Footnote. Lebanon's 2019 to 2021 banking freeze destroyed an estimated $70 billion in deposits. The Lebanese pound fell from 1,500 to over 100,000 per USD. 9. The modern illusion. From 2008's bank bailouts to 2023's regional collapses, the lesson repeats. Your money in the bank is a loan, to them. They decide when to repay it. Every system works perfectly. Until it doesn't. Protection today means the same thing it did in Byzantium: hold what cannot be printed, controlled, or frozen. Real assets, real skills, real independence. So what does that actually mean? It means the future belongs to the doubters who prepare, not the believers who wait. Footnote. Systemic fragility persists across eras. Wealth preservation requires decentralization of assets and income streams. 10. The final pattern. Every collapse transfers wealth from paper to substance, from the many who trust to the few who question. The survivors of history aren't those who pray for rescue, they're those who plan for ruin. Money fails. Trust fades. But human ingenuity, production, trade, skill, endures. When illusions collapse, builders inherit the world. Footnote. Long-term survival in monetary crises depends on tangible value creation, productive skill, resource ownership, and liquidity.